You can experiment with your investments. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like healthcare. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Okay, we're talking emerging markets and frontier markets. We're pleased to have with us Tendai Musikavanhu. He's the CEO of Old Mutual Global Index Trackers. Tendai, great to catch up with you.
Thank you.
Let's begin with, if there's one investment category that I think investors are missing, I would say, or have no exposure to, I would say it's probably emerging markets or frontier markets. Explain to us the difference between both of them.
Well, I think the best way to see emerging markets and frontier markets is emerging markets is obviously one step below developed markets in terms of extent of development, the sophistication of the markets, the liquidity and ability to trade in and out. Frontier markets is just one step below emerging markets. These are quite arbitrary distinctions, typically made by size of markets, level of sophistication of that market, as well as regulatory and other considerations by the various indexing authorities out there, as the MSCI.
So thinking about this in terms of actual countries, we think about emerging markets, the BRICs, Brazil, China, India, Russia. Give us maybe some examples of frontier markets or frontier countries.
Yeah, they vary. I mean, you've got Argentina, on the other extreme Pakistan, you've got Slovenia, Nigeria, amongst others. So you've got quite a nice mix there.
Now, in terms of market liquidity, I mean, that might be a concern for some investors. Give us some idea in terms of liquidity in frontier markets.
Well, giving you a sense of liquidity, I think the best way to look at liquidity is the impact it has on investors from a cost point of view. So when you look at the cost of entering the frontier markets, our tests have shown that it can cost you as much as 217 basis points to enter in terms of liquidity cost. And obviously if you're going in and out, your portfolio does that once a year, that's 434 basis points. Emerging markets, if you contrast that, emerging markets are about 49 basis points, so therefore the double journey is about 98 basis points round trip. So right there you can see there's a quantum leap of difference in terms of the liquidity of those markets.
So how does an investor minimize that impact of that cost? Is there a way to do that?
Well, this is where passive fund management comes in. So, you know the efficient market hypothesis?
Sure.
Sounds great on paper. I think like communism sounded like a great idea, right, in the beginning. And then what happened?
Until you try it.
Yeah, exactly, until you try it. The same sort of thing. The efficient market hypothesis in these illiquid markets for active fund managers is going to be prohibitively expensive for them to trade in and out of ideas that they may have and may want to implement. And so that's why if you have a buy and hold strategy through a passive fund manager, it's probably going to work out better in the long run.
One last question, Tendai, before you take off. What percentage of assets or what part of their portfolio should people, do you think, be dedicating to this particular asset class, frontier markets?
Well, I'll say the typical caveat about each investor having their own risk appetite and risk capacity and etc. and therefore would need to consult their experts. But from our point of view, when we look at the various indices, the MSCI, if you take the frontier markets, including the Gulf countries, some people strip the Gulf countries out, but if you include them, that's about 0.4% of the portfolio that should be there. I would say that if you want to get a decent size for frontier, you're probably looking at about 1%. Of a portfolio that's got some risk appetite. Some people tack on a blend of the emerging markets and the frontier markets. And that's quite nice because then you're going to get a 15%, 16% exposure to the blend of emerging markets and frontier markets.
Thanks for joining us. You just heard from Tendai Musikavanhu, CEO of Old Mutual Global Index Trackers. I'm DeLegge with ETFguide. Thanks for joining us.